Hello and welcome to another lecture of Econ 2301, Principles of Macroeconomics. This lecture will go over the money and banking system. It corresponds to chapter 13 of your book. We'll take a close look at how banks act as financial intermediaries. We will also see how they create money through the process of deposit creation. So let's start off with what is money? We need to define it before we can talk about it. Money is any item that is regularly used in economic transactions or exchanges and accepted by, and this is important, both buyers and sellers. For instance, we trade currency for an ice cream cone. The ice cream owner trades because the currency can be used to pay for other things. The cost of production, employees, wages, etc., profits to buy other goods. Actual transactions usually include the use of checks that instruct a bank to transfer money to another individual. Anything that can be used to buy something is money. So even though it may be a physical check, it may be a debit card, or a dollar bill, it is money. You will see on this slide I have three symbols for various currencies in the world. The first is the dollar bill. The second is the yen, and the final one actually is the euro. What is really interesting, and I asked this in all my classes, a lot of people assume that China is the Chinese yen and that's where it's located. However, it's actually Japanese yen and Chinese yuan. The properties of money. Alright, there are three specific properties of money for it to be money and used in exchanges. The first, it must be a medium of exchange. Any item that buyers give to sellers when they purchase goods and services is the medium of exchange. We need to look at exchange in other ways. First is barter, and this was the first form of exchange. This is trading with one another, one good or service. It's very inefficient. I might trade a goat for a dog, or in long time ago, I might have traded livestock for a wife or servants, etc., etc. The problem is trying to get the value succinctly lined up and having both incentives match. You may value what you have to trade more than what I value it. For example, a couple months ago, I wanted to trade my pickup, or actually trade my car for a pickup. And I found someone in Lubbock who was willing to make the trade. And when we met up, we started discussing each of our vehicles, and it was very evident that each of us valued our own vehicle a little bit more than the outsider did. He had sentimental reasons for valuing his pickup. It had taken him to Houston and back many, many times. He was able to do a lot of work with it. All I saw was that there was a lot of usage and wear on the tires, essentially. And I felt like that devalued it. But he felt like because of the trips he took, it actually increased its value. My car, on the other hand, personally, I felt like it was very dependable. It got me back and forth to work. I had had some scrapes and essentially some fender benders along the way, but the car itself had been very, very dependable. To him, what he saw was that it also had a lot of wear on the tires, and it had been beaten up. It wasn't in the best condition on the outside cosmetically. He didn't think of the fact that it got great gas mileage and got me to and from work as necessarily the benefit. He just viewed it as, this has a lot of miles. So we were at an impasse, and obviously the trade did not happen. This is because of double coincidence of wants. In order for the barter to actually go through, each person must want what the other person has and have similar desires. Remember the principle of voluntary exchange, which we talked about from the first few chapters? A voluntary exchange when two people or both parties are better off. The second property of money, it must serve as a unit of account. This means that I can compare it with other things and know specifically how much it's valued at. Now, I don't need to know it in terms of ratios versus the euro or peso or something like that, but what I do need to know is that I can use it as a specific unit of account when I'm talking about various things. Whether it's buying something that has value, I can say this is $30. I have a standard unit of account there. Or whether I'm applying for a job and I get paid $10 an hour, or you tell me that this house is worth $100,000, all of that is a standard unit of account. If you think about it, just think of it this way. It's just simple measurement. Very simplistic. What we can do with the dollar, and if it's a standard unit of account in money, we can use it to form our base point. Just like you, if I were to ask you how tall you were or are, you would say, I'm 5 foot and maybe 10 inches. Just like myself. What you're getting at there is a standard unit, which I can quickly calculate in my head. Okay, that's this much. I don't necessarily need to adjust for inflation. I don't need to say, well, that's compared to other people, various heights. I can get a good gauge. Just like if I were to ask how much you make, you would probably say, $8 an hour. I have a very good gauge there. Thirdly, money serves as a store of value. The property of money that money preserves value until it is used in exchange. In other words, money itself doesn't necessarily have value. It's the fact that I can use it and eventually get that value. That's what preserves it. The fact that in the future I can still use it makes it money. Now, if I have a dollar bill and I believe the country is going to go to ruin in the next few months and there won't be any reason to have a form of currency, then that would not be a store of value. We saw some of this in Iraq where the Iraqi, I can't remember exactly what their currency is, but it lost a lot of value during the Iraqi war, and then it gained a lot of value. But that store of value, a lot of people didn't know whether they could use that particular currency in the future as we took over the country, and whether there would be a new currency implemented. And so it was very volatile with that fact alone. Different types of monetary systems. The first is commodity money. This is a very ancient, antiquated type of system. It's a monetary system in which the actual money is a commodity, such as gold or silver. It's similar to the old Western days when someone would walk into a store and open up a big sack of coins and have tons of gold coins and silver coins and put them down on the counter and buy things like flour and feed, etc. That's a commodity system. Now, it's very inefficient because you have to carry around the gold or silver, and it could be anything. It could even be livestock. That's your form of currency. And it's so inefficient because you're actually physically carrying around this money. The next system is the gold standard. Now, there is a lot of controversy over this. I'm going to quickly say my opinion on it, and I just want you to know that you are free to research it however you feel. Personally, the United States does not need to be on the gold standard. It's ridiculous that people say we need to go back to the gold standard. It's a monetary system in which gold backs up paper money. And here's why I don't think we need to. We're incredibly wealthy. In fact, the dollar bill in and of itself can multiply, and we'll look at that in a second, and create growth without us backing it up with gold. I can, for instance, just with the multiplier effect, I can go out to eat, tip that waitress, who can then go to Walmart, and that employee at Walmart can take my class, and by taking my class, she's increasing my demand and increasing my wage. Nowhere in there did I implement gold. Now, I'm not getting political on it or saying that we're putting the economy at risk. What I'm saying is just by the mathematical equation of the multiplier effect, as it comes around and the economy is growing, we can see growth in the dollar in and of itself. Now, the debt issue is a completely different argument, and I completely understand that not going into debt could be or is a good thing, that you don't want to have too much debt as a country, especially as a rich country, but that doesn't mean that you should just erase the debt and implement a gold standard. Now, all that being said, if you're a poor country or a third world country or a developing country, the gold standard makes a lot of sense. The dollar bill is used in the majority of countries in the world today as far as being the most standard currency. A lot of poor countries like Zimbabwe, Sub-Saharan Africa countries in Sub-Saharan Africa, they use the dollar bill, and that's a really good thing. One, it helps our value because that means that they want it, and two, it's because they can't establish a credible currency. So poor countries, it makes sense. If you're going to establish your own currency, back it up with gold. Now, once you get developed and you're rich enough, let the currency stand on its own. That makes sense. Now, that doesn't mean to print so much money that you get in the same predicament as the United States, but you can get off the gold standard and let the money stand upon itself. Alright, that's enough of that soapbox. Let's go on to the currency or monetary system that we have. It's called fiat money, a monetary system in which money has no intrinsic value but is backed up by the government. Now, what it means by it has no intrinsic value, you can't get the value of money just by having it. You actually have to purchase something. You have to have some form of exchange to get that value. And by being backed up by the government has specific regulations on what money gets produced, what it looks like. Not anybody can make money. We have very stiff penalties if you try to fraud our money, counterfeit our money. And we also have very strict rules on going into debt and which ways we can do that and the tools that are used. Now, whether we abuse that or not, we do have very strict rules by that, and so it in essence is backed up by the government in that sense. Alright, measuring money in the U.S. economy. Now, this is only money. This isn't investments. This is actual currency that you can use. Remember, we talked about checks and debit cards being money because you can use it as a form of exchange anywhere. I can't go to my local United and say, I have Apple stock. Let me give you this Apple stock and you give me groceries. It doesn't work that way. I can give them a traveler's check. I can give them a check or use my debit card or cash. That will work. So M1 is the first thing that we use to measure money in the economy. And it's the sum of currency in the hands of the public, demand deposits, other checkable deposits, and traveler's checks. Think of it this way. This is the most liquid of all money. It's something that you can quickly get out of your bank without much effort. A lot of people tell me that there's not very many people that use cash in today's world. Actually, currency held in the public is the biggest percentage of M1, believe it or not. And that makes sense because truthfully, you don't want to have too much money in your actual checking account or demand deposit. You would probably see most people, once they accumulate some savings, move it from the checking account into their savings account. And therefore, the currency held by the public, which that is typically used by people who don't have checking accounts, who use it continually and on a continuous basis, you would typically see them not have savings. So it kind of does make sense when you think about it. Alright, M2. This equals M1 plus other assets. And essentially what we're doing is we're having all of the economy, or the money in the economy, be measured. And the way we look at that is we include deposits and savings and loans and accounts in money market and mutual funds. Now, these are all the saving type vehicles that are used within our country, and we add that to the actual currency that's very liquid, and this gives us M2. Notice, once again, we're not looking at the investments such as stocks. We do have market mutual funds, but those are savings accounts that are typically paying a higher rate, but they're not as risky. They typically do not lose money. They may not always make that much, but they would not be subject to the risk that a stock would. So they have more credibility and less volatile nature. And you'll notice that savings deposits are actually the biggest percentage. And what's interesting is beforehand, when we looked at just M1, we saw the cash on hand, the physical cash on hand, being the biggest percentage. And when you add all the wealth that people have and the money that's not just located in their checking accounts, we see that it actually flip-flops, and the savings becomes money that's not physically held, becomes the largest percentage of money in the economy. So now let's look quickly at how banks create money. A balance sheet is an account statement for a bank that shows the sources of its funds, as well as the uses of its particular funds. Now, this is going to confuse some of you. If you haven't had accounting yet, what I suggest you do is real quickly flip everything that you think about money on top of itself, or put it backwards. When you owe someone, now think of it as them owing you, and when you have money, think of it as not having money. You'll see why in just a second. So liabilities with a bank are the sources of funds for a bank, including deposits and owner's equity. Remember, I said to flip everything you think of on its head. Anytime you put cash into the bank, they're liable. They owe you that money. That's not their money. So actually having physical cash in the bank is not an asset. It's actually a liability. It lowers the amount of money, the total asset, the value of the bank. The more money that they have on hand is actually more liability. But what they do is they take the money that you put within the bank and they loan it out. This becomes assets. The use of funds of a bank, including loans and reserves. It's kind of interesting how it's flipped. Just like I said, anytime they have cash on hand, that's a liability that you deposited, not their own cash that they made from profit. But anytime you deposit into a savings account, checking account, or you own a percentage of the bank, that is a liability. They owe you that money. You can take it out at any time. But when they loan or give other people your money or the money that's in the bank, requiring them to pay it back with interest, that becomes an asset for the bank. Owner's equity. These are funds provided to the bank by its owners, similar to owner's equity in a business. It could be cash options such as securities and things like that. Well, just what you need to know by it is it's the funds provided to a bank by its owners, essentially like the stock or common shares. It can be all kinds of things. It's just money that has been given to the bank, and you have a say in how the bank does the particular things. However, that bank owes you back that money. Alright, a bank's balance sheet. This is where the money comes from, and it shows where the money comes from and where it goes. First off, let's talk about reserves. These are the portion of bank deposits set aside in either vault cash or as deposits at the Federal Reserve. This is money that they don't lend out when you make a deposit in the bank. So whenever you make a cash deposit in the bank, let's just say it's $1,000, and they keep back 10% or $100, then they have $100 in reserves. Now you might be asking, why would they do that? Well, at any time you can take your money out, and so they're going to keep a small portion of it and not lend it all out so that you can get that money at any time. And you might be thinking to yourself, well, why don't they just keep it all on hand? Well, on a grand scale, it's okay to not keep it all on hand, to keep just 10 to 15%, because in that instance, it's very unlikely that every single customer at the bank will come in, or account holder at the bank will come in and withdraw all their funds at one time. Required reserves. These are the specific fraction of their deposits that banks are required to have on hand by law. This is what the government or Federal Reserve requires them to have. Any additional reserves held above the level of required reserves are called excess reserves. Now, it's good to notate that some banks, especially when they're starting out, they're going to be more conservative and have more excess reserves. The problem with this is it actually lowers the growth of money in the economy, and we're going to look at that in a second, because the way that money grows within the economy, and this was one of the problems with the credit freeze in 2008, 2009, with the bank bailouts, is that they stopped loaning money. Yes, that helps the bank and it puts them at less risk, but at the same time, money doesn't circulate through the economy, creating wealth. Alright, let's look at that more closely. How do banks create money? If someone were to deposit $1,000 in a bank, let's just say First Bank of Hollywood, and the bank is required by law to keep 10%, then they'll keep $100 on reserve, and they'll loan out $900. Well, whenever they loan out that $900 to the next business or individual, that particular individual will probably go to their own bank, let's just say Second Bank of Burbank, and deposit it. So now they have $900 deposited in the next bank, which would be a liability. That bank in turn will keep 10% as a reserve, just like their other bank required by law, so $90, and they'll loan out $810. We see this chain continue on down in this graph on the right side of your PowerPoint slide. And what happens is that we see a multiplying effect as the interest rate gets paid back. Remember, this is not just the same amount loaned out each time. Eventually, once it gets paid back, it will be a much larger percentage. And so we'll see a money multiplying effect and grow the economy. And each of these banks will be able to lend out more in the future. How the money multiplier works when talking about banks: the initial cash deposit times 1 divided by the reserve ratio. Now, you're not going to need to know that for the exam. I just want to show it to you in this presentation slide. The higher the reserve ratio, the smaller the money multiplying effect. That means the economy doesn't grow as fast. Just like I said previously, if a bank holds more money, then we'll see the economy kind of freeze because credit's freezing and people aren't able to get the loans that they need. At the same time, interest rates are not getting paid, bank profits aren't increasing, and we're not seeing a money multiplying effect. Now, this typically happens during downturns in the economy, and that's because banks become very conservative when things are going bad. Now, when things are going really great, we see this reserve ratio decrease to the point of just a required reserve ratio, because the banks are not going to hold any more on hand than they absolutely have to. Because if you recall, loans are assets to the bank, and in order to increase their worth, they're going to increase their assets. The money multiplier definition is just a ratio of the increase of total checking account deposits to an initial cash deposit. So what would happen is if we deposited $1,000 and over time as it got loaned out, if that was a 10% money multiplying effect, we'd see $1,100 after the effect. The money multiplier working in reverse decreases the money supply. That makes sense and that's what I just kind of said above, if the banks hold the money, then the money supply will be decreased or stopped. The flow of money just stops. Alright, let's talk about the Federal Reserve. The Federal Reserve is a central bank. A central bank is a banker's bank, an official bank that controls the supply of money in a country. They typically are the lender of last resort. Unfortunately, as of late, they have been the lender of first choice. And that is because their rates are so low. Right now, the federal funds rate, which is the rate at which the Federal Reserve Bank loans other banks money, is at 0 to 0.25%. With it being this low, it is very likely that banks are going to borrow money from the Federal Reserve rather than borrow money from you. Hence why your savings account doesn't pay anything at all. Alright, the Federal Reserve, how they supply currency to the economy. Working through the banking system, the Federal Reserve is responsible for supplying currency to the economy. Although currency is just one component of the money supply, if individuals prefer to hold currency rather than demand deposits, the Federal Reserve and the banking system will facilitate the public's preferences. What that is saying is they will change interest rates to kind of stir up or start the ball rolling as far as increasing the money supply or decreasing it. If they make it too expensive to borrow money, then they can quickly decrease the currency. And this would be a contractionary policy, just like we talked about in previous chapters. From the standpoint of the government or the Congress, this would be done from the Federal Reserve side. And what they do is by making it more expensive to borrow money, they can decrease the supply of currency. And this is only done in times of serious hyperinflation or fear that we will see bubbles in inflation. The Fed provides a system of check cashing and clearing. This is probably the most essential part of the Federal Reserve Bank, but it's definitely not the most attractive or romantic part of it. Very few people talk about it. More people talk about the interest rate and monetary policies rather than just the back end or the clerical side. What they do is they make sure that money goes freely through all the banking system, or the banks in the banking system in the United States. Every bank has a routing number. You have a routing number at your bank. You have an account number, and anytime you write a check, it goes to the Federal Reserve electronically and back to another bank. This is done almost instantaneously, and it's rarely flawed. It works so well that it's just amazing that we don't hear more about it, but it's just because it works so great. Functions of the Federal Reserve continued. The Fed also holds reserves from other banks. Remember, we talked about that mandatory reserve. Well, part of the reason why they hold a lot of money is because of the FDIC insurance that we talked about in the previous chapter, the Federal Deposit Insurance Corporation, that insures up to $250,000 of each account at a bank. The reason why they want banks to hold some money as reserves is they want to keep the financial system safe, and they would rather not bail out banks or issue out $250,000 in insurance on account holders. They would rather banks be able to be solvent and profitable on their own. The Fed conducts monetary policy as well. Monetary policy is just the range of actions taken by the Federal Reserve to influence the level of GDP or inflation. Essentially, what they do is they just look at the target rate of GDP and say we need to grow at 3.5%. The way to do that, because the economy is not growing fast enough, is to lower interest rates and make money much cheaper to buy and borrow. Or the economy is growing too fast and causing inflation. We need to make money much more expensive and therefore decrease the growth rates. It's much cleaner than Congress, and I'll talk about it in just a second, but their approach, the Federal Reserve, is much more trustworthy than Congress. The structure of the Federal Reserve. The Federal Reserve Bank is essentially one of 12 regional banks that are an official part of the Federal Reserve System. So there are 12 Federal Reserve banks that make up the Federal Reserve System. As you can see, they're located in those 12 places. In my own opinion, probably the most influential and most important one is the Federal Reserve Bank of New York. This is because they are located directly across from Wall Street. They have the knowledge of the financial markets on hand. And if you think about it, Dallas, San Francisco, Kansas City, they're focusing on their specific area that's highlighted. And that makes sense. In Dallas, the Federal Reserve Bank of Dallas is going to have many analysts analyzing the prices of oil, cotton, a lot of agriculture, as well as education in Dallas, Texas, New Mexico, things like that. Well, all of the things that I said affect the financial markets, the New York Stock Exchange as well as Wall Street. So New York will have some idea what's going on in the oil markets, just like the Federal Bank of Dallas. However, the Federal Bank of Dallas is not going to have complete understanding and knowledge of what's going on in New York. So that's why I believe the Federal Reserve Bank of New York is definitely the most influential. Alright, the Board of Governors of the Federal Reserve. This is a 7-person governing body of the Federal Reserve System in Washington, D.C. These are kind of the outsiders, even though they typically are academics who worked in banking, but for the most part, we want them to come from different industries such as agriculture, cotton, education, not just finance. And they're typically nominated by the president, especially the chairman, and approved by the Senate. The Federal Open Market Committee. This is the group that actually decides the monetary policy. They set the interest rates for the country, and that really dictates the mood of the country. Remember how I said they're more trustworthy? They are very, very tight-lipped about what's going on in the economy. This group makes up the 7 Board of Governors plus 5 regional bank presidents on a rotating basis. The Federal Reserve Bank President of New York is always in that mix. Remember, I said they're most influential, so they're typically always in that mix. They serve 14 years. The reason why they serve 14 years rather than our congressmen and senators who only serve 2 and 6 is that the economy can change a lot over 14 years, right? There can be ups and downs. We don't want someone to come in and serve only 2 years and experience the Great Recession and be so freaked out by it that all they want to do is bail out every single company and print money without any restrictions. By the way, the bailouts that happened that were not regulated were not done by the Federal Reserve. Those were done by the Treasury Secretary and Congress. The Federal Open Market Committee, if you notice, they have 7 members that are made of the Board of Governors. Those are the outsiders, and only 5 regional bank presidents. The reason why we do that is because in the event of a tie, the 7 majority comes from the outsiders. We would rather the people who are in the industry make the decision than just the bank presidents. Once again, I said they're tight-lipped and more trustworthy. That's because they're not going to talk that much. They don't want to tell us very much. because anything they say, they are trustworthy, anything they say can influence the economy. If they were to just briefly say, we are worried about a particular company or industry, such as the auto industry, they could put hundreds of thousands of workers in the United States at risk. It got so bad as far as monitoring what they do, the Federal Open Market Committee, during the Great Recession, that the Federal Reserve Chairman, Ben Bernanke, he was looked at by analysts every time he went into a building, and any time he had more than one briefcase or a lot of papers, it was viewed as bad, because he's going to be working a lot, right? And the economy can't be good if he's working so much. Anytime he would go into a building and he wouldn't be carrying anything, it would be viewed as good. The economy must be getting better. Now, compare that to the President of the United States or your local congressman. They talk all the time. Would anybody make note whether President Obama or the Speaker of the House was carrying more papers or not? No. In fact, they can apologize for lying to us and everything is okay. If the Federal Reserve Bank apologized for lying to us about the economy, things would not be good. In fact, we would probably see a sell-off in the financial markets and a close recession or depression. This chart just shows you how the Federal Reserve is set up. By the way, interesting note, we are about to see history. Starting in January, Federal Reserve Chairman Ben Bernanke is stepping down, and Janet Yellen will be the next Federal Reserve chairperson or chairman, chairwoman, I guess. And she will be the most influential financial person in the United States, if not the world. She is the first female to hold this position. So it's really interesting. I want to see how she does. She's definitely an academic, but I think she'll do a good job. Alright, I hope you enjoyed this lecture. If you have any questions, please email me at jkemper@southplainscollege.edu or hit me up on Twitter @Mr. Kemper.